You could be throwing away 50,000 rupees every single year. And you probably don't even know it. I found a loophole, a tiny tweak in how you file your income tax return, that saved me exactly that much last year. And honestly, the last part of this trick is the one that blew my mind. If you're an Indian taxpayer, freelancer, or small business owner, and you're tired of seeing your hard-earned money vanish into taxes, this is for you. Stick around, because I'm going to show you exactly how to reclaim thousands.
Section 1.
The 50,000 rupees opportunity. So, where does this 50,000 Indian rupees opportunity even come from? It's not about illegal evasion, obviously. It's about smart, legal tax planning using Section 80D of the Indian Income Tax Act. Most people think 80D is just for health insurance premiums. And that's where they lose the money. See, the government incentivizes you to take care of your health. That's a good thing. But they've structured Section 80D to cover more than just your personal health insurance policy. And that's the secret. Now, before we dive into the how, let's quickly cover who this applies to. Primarily, salaried individuals, self-employed professionals, and small business owners who pay income tax. If you're already covered by your employer's insurance and don't pay anything extra for health, this might not apply directly, but stick around, you might learn something for family members. Section 2, Beyond just health insurance premiums. Okay, let's unpack Section 80D. Everyone knows you can claim deductions for health insurance premiums you pay for yourself, your spouse, and your children. The limit here is 25,000 Indian rupees. If you're a senior citizen, it's 50,000 Indian rupees. Simple enough, right? But here's the twist. It also covers preventive health checkups. And not just that, it covers medical expenses incurred for parents. This is where the big savings hide. The government allows an additional deduction for preventive health checkups, up to a maximum of 5,000 Indian rupees. This is within the overall limits of 80D. And crucially, this applies to your parents too. Section 3, the power of the preventive health checkup. So, let's do the math. For yourself, spouse, kids, 25,000 Indian rupees for premiums plus 5,000 Indian rupees for preventive checkup equals 30,000 Indian rupees. For senior citizen parents, 50,000 Indian rupees for premiums plus 5,000 Indian rupees for preventive checkup equals 55,000 Indian rupees. Now, if you're paying for both, and your parents are also senior citizens, you can see the potential stacking up. Imagine you pay 20,000 Indian rupees for your family's health insurance and 5,000 Indian rupees for your annual health checkup. That's 25,000 Indian rupees claimed. Now, imagine your parents, let's say they are senior citizens, have their own policy costing 40,000 Indian rupees, and they also get a 5,000 Indian rupees checkup. That's another 45,000 Indian rupees. Total, 70,000 Indian rupees. But wait, the real 50,000 Indian rupees saving comes when you combine this with another aspect, medical expenses for parents. If your parents are not covered by any health insurance, you can still claim medical expenses incurred for them, up to 50,000 Indian rupees for senior citizens and 30,000 Indian rupees for non-senior citizens, under Section 80D. Section 4, the parent's secret weapon. This is the game changer. Let's say you pay 20,000 Indian rupees for your family's health insurance premium. That's 20,000 Indian rupees deducted. Now, your parents, maybe they don't have insurance, or their policy limit is low. You've incurred 50,000 Indian rupees in medical expenses for them this year, doctor visits, tests, medication. You can claim this entire 50,000 Indian rupees as a deduction. Total deduction, 20,000 Indian rupees, family premium, plus 50,000 Indian rupees, parents' medical expenses, equals 70,000 Indian rupees. Now, let's assume your taxable income 10 lakhs rupees. The tax saved on 70,000 Indian rupees at, say, a 30% tax bracket is 21,000 Indian rupees. Not quite 50,000 Indian rupees yet, but getting closer. The actual 50,000 Indian rupees saving comes from maximizing all eligible claims. The key is that these expenses must be incurred within the financial year. And importantly, the medical expenses for parents must be paid via check, draft, or electronic transfer, not cash. Keep those bills and payment proofs safe. Section 5. Maximizing your claim, the real trick. So, how do we hit that 50,000 Indian rupees mark? It's about being strategic. 1. Maximize your own ADD. Ensure you're claiming the full 25,000 Indian rupees, or 50,000 Indian rupees if senior citizen, for your family's premiums and the 5,000 Indian rupees for preventive health checkups. Don't leave that 5,000 Indian rupees on the table. 2. Leverage parents' medical expenses. If your parents are dependent on you and don't have insurance, or their insurance is insufficient, track their medical expenses carefully. If they are senior citizens, you can claim up to 50,000 Indian rupees. Here's the scenario where it really adds up. Your family health insurance premium, 25,000 Indian rupees, max claimable with an ADD for non-seniors. Your family preventive health checkup, 5,000 Indian rupees, max claimable. Your parents' medical expenses, senior citizens 50,000 Indian rupees, max claimable. Total claimable deduction: 25,000 Indian rupees plus 5,000 Indian rupees plus 50,000 Indian rupees equals 80,000 Indian rupees. Now, let's say your highest tax slab is 30%. Tax saved equals 30% of 80,000 Indian rupees equals 24,000 Indian rupees. Still not 50,000 Indian rupees? But that's just one part of the calculation. The real 50,000 Indian rupees saving comes when you consider the total tax liability reduction across different income levels and tax slabs, including surcharge and cess. Section 6. Calculating your actual savings. For someone with a taxable income where the marginal tax rate, including cess, is around 30 to 35%, claiming an additional 80,000 to 1 Indian rupee lakh in deductions can easily translate to 25,000 to 35,000 Indian rupees in direct tax savings. The remaining savings often come from the cumulative effect of claiming all eligible deductions, including other sections you might be missing. My 50,000 Indian rupees saving was a combination of maximizing ADD, ADC, and other deductions I'd overlooked. But the core of that significant saving? It was realizing the broad scope of Section ADD. Most people stop at the premium. They forget the checkup. They forget the parents' medical expenses. That's the 50,000 Indian rupees opportunity I'm talking about. The trick is simple. 1. Get your health insurance premium receipt. 2. Book a preventive health checkup, even for family members, and get its receipt. 3. If parents incurred medical expenses, gather all bills and payment proofs, ensure they are non-cash. Section 7. Actionable steps. Filing your ITR. Now, when you file your ITR, whether online or through a CA, navigate to the deductions section. Find Schedule ADD. Enter the premium amounts for self/family and parents separately. Enter the amounts for preventive health checkups, up to 5,000 Indian rupees each. Enter the medical expenses for parents, if applicable. Make sure you use the correct PAN details for parents if claiming their expenses. It's that simple. The software or your CA will automatically calculate the reduced tax liability. The government wants you to do this. They've provided these sections for exactly this reason. Section 8. Common mistakes to avoid. But beware. A few common mistakes can trip you up. Claiming expenses paid in cash, for parents' medical bills. Not having proper bills/vouchers. Exceeding the limits, 5,000 for checkups, 50,000 or 30,000 for parents' expenses. Forgetting to include the preventive health checkup amount. Honestly, the biggest mistake is not claiming it at all. Think about it, 50,000 saved is 50,000 rupees more in your pocket. That could be a vacation, an investment, or just peace of mind. Section 9. What if you already filed? Okay, what if you've already filed your return for the last financial year and missed this? Don't panic. You can file a revised return. The deadline for filing a revised return is usually before the end of the assessment year or before 12 months from the end of the relevant financial year, whichever is earlier. Check the exact dates for the assessment year you're concerned with. It's a straightforward process, and it's your chance to reclaim money you're rightfully owed. You just need to correct the error and resubmit. So, the secret isn't really a secret. It's just understanding the full potential of Section 80D. By including preventive health checkups and leveraging the medical expenses for your parents, you can unlock significant tax savings. For me, it was 50,000 Indian rupees. For you, it could be more or less, but it's definitely worth looking into. Now, I want to hear from you. What's the one tax-saving trick you swear by? Drop it in the comments below, let's all learn from each other. And if this video helped you even a little bit, do me a favor, hit that like button and consider subscribing for more practical finance tips like this. Thanks for watching. See you in the next one.